Morning all. Yeah, this is just a brief presentation on what I kind of do as a corporate lawyer, just a high level view. Appreciate it's Friday morning. So yeah, name's Philip Miles. I'm a corporate solicitor. I work at a firm called Bexley Beaumont. Um, Presentation overview. Look, I'll just quickly give a bit about myself, and then I thought it might be helpful if I just present a few of the things that I do on a daily, weekly basis as a corporate lawyer. Try and keep it brief to keep you all awake. So, look, my background over 10 years of doing this. As I say, I work with Bexley Beaumont. We're a network of lawyers externally facing. We just look like a normal law firm. We are, but everyone there is well, most people there are a consultant solicitor, which means self-employed, acting through their own business. What that really means for clients is that we tend to be more flexible on fees. No one tells me what I need to charge. I charge what I want, and that effectively feeds its way back to myself. And importantly, I manage my own caseload. I don't take on too many jobs, so I can always deliver client service. My logic there is if you take on too much, you do too much, you end up losing the clients because you can't deliver. And clients, my focus really is on owner managed businesses. Love dealing with business owners who they are running it and they need that help and they need that legal support along the way. They don't have in-house legal teams. They're generally SME type businesses that can just really benefit and get the additional value from having a trusted legal advisor alongside them. So something I do a lot of, especially in the run up to any sort of budget, certainly a Labour budget, is selling of businesses, or whether it's a company, a share sale. So fundamentally, it comes down to two questions really, and it always comes down to money. In effect, it's how do I receive the money as a client, as a seller, and how can I lose my money? What are my liabilities and restrictions? And that all really comes down to and is governed by a share purchase agreement. So look, how do you receive your money? It's a simple question. It's a difficult answer. Ideal utopia is get it all on day one. You haven't got to worry about the buyer not paying you your money. That's uncommon, certainly nowadays. We tend to see a lot more buyers structuring it by way of some sort of deferred tranches, 1 year, 2 year, 3 year, monthly earn out. So what that means is that's contingent on the seller actually performing in the business rather than just getting a lump sum irrespective of how the business performs. And then some other structures, loan notes and preference shares, which I won't bore you with, but it all blends into deferred consideration. How do I help there? Well, really getting involved initial stages to kind of push for as much of that on day one. Buyers will always try and hold back as much as they can. It just helps their cash flow to not use a big slug of cash on day one. And whatever's left deferred, it doesn't have to be a full stop there. We need to make sure that the buyer can make those payments. A lot of the time, it's a newly incorporated company, doesn't have a strong balance sheet, if anything, on the balance sheet. So we need to push for some security, guarantees from other members of that group company to make sure if the buyer misses a payment, then the sellers can get the payment back from them. Another way of doing it is, and this is less common on smaller transactions, is but by way of an escrow account, just putting it somewhere so the buyer can't go and spend the money. Believe me, it happens, and I'm sure Melissa sees that quite a lot as a cause for concern. So that's how they get their money. How can they lose their money? How can the seller lose their money? Well, it's by way of what they give under the agreement. Your starting position at law is caveat emptor, buyer beware. If the buyer buys a bag of nails, they've got a bag of nails and no recourse. Obviously, that's evolved, and you put it onto the seller as a buyer, and you say, no, you give me some warranties about the status of the business. You tell me that these are factual statements, and to the extent they're not true, I've got opportunity to bring a breach of warranty claim. Oversimplifying it a little bit, but how do I help there? You don't have to take the warranties as read. We as lawyers acting for sellers will bring that more to a seller friendly position. Buyers try it on. We've stupid warranties that you just wouldn't give. So we tailor that more to a seller-friendly position. In addition to that, as a seller, you're afforded what's known as a disclosure letter. Long story short, it's basically you get to tell the buyer where any of these warranties aren't correct. And the beauty of that is, with some exceptions, anything the buyer knows, you can kind of say, look, you can't bring a claim against me because you knew about it. The disclosure letter is a really important tool to any seller on sell side. It's a really big part of what we do when we're advising sellers, making sure that's properly drafted. And Melissa will be able to attest to that. Anytime there's ever a warranty claim, the first thing you will look at as a litigator will be the disclosure letter. Did the buyer know about it? Were they made aware of this? And then other ways you can deal with that is by way of financial limitations. So just because you've got a claim, if you said warranty that, we've got all the equipment we need to run the business, and it turns out there's no biros in the business, clearly you're not going to send a claim for £5. It sounds arbitrary, but believe me, silly claims can happen. So you put like a minimum cap. You can't bring a claim unless it's £5 grand, £10 grand, and these are just rooting out some of the ways a seller could lose the money. And then additionally, you'd put in time limitations. It can't go on forever. A couple of years, you've been in the business 2 years as a buyer. You've had the opportunity to work out if it's a bag of nails, if there's anything gone wrong. You've probably gone through 2 accounting cycles there. After that 2-year, 3-year period, you shouldn't be allowed to bring a warranty claim. And that's, pulling that position back to a more seller friendly and protecting them. And then other ways is, like I say, around knowledge that the buyer has. Another way you can lose your money is indemnities. Sorry for oversimplifying this, but basically it's just an indemnity different to a warranty. It's just a promise to pay an amount to the buyer if a specific event happens or occurs. For instance, if we said if the buyer knew there was litigation against the company and it may or may not happen, then you couldn't cover that by a warranty because the buyer's aware. So the way you would deal with that is by an indemnity, and just basically the seller says, look, if this ends in a claim and it costs you money, I'll cover you the cost of that. Is a short way of saying it basically. Again, that's not just a full stop. How we help, acting as advising sellers, we'll be saying, well, the indemnity needs to be properly scoped. It can't cover everything. We want to make sure it's properly specific, and also back to financial and time limitations. There's got to be some sort of minimum amount. There's got to be time. It can't go on forever. So those are the 2 key ways that a seller can lose their money once they've received their consideration. Good segue to say on this one. I deal with the advising of the sale and the purchase and the negotiation of the warranties. If you've got a situation that's gone terribly wrong and there's a dispute going on, that's not me. That's definitely Melissa Worth, who I think is on the call today. So that's definitely one for her to pick up, and I definitely recommend Melissa's services. We've worked together in the past. Again, other side of the table is buying a business. It's easy to say I just do the complete opposite to what I said I would just do, acting for the sellers. It's not. It's a more nuanced than that. It's working with the buyer, pulling together a set of heads of terms. It's doing the due diligence on the company, kicking the tires, making sure the company is decent as the sellers say it is, and then that flows into the sale and purchase agreement, making sure the warranties are properly drafted and the indemnities reflect that. And look, most people I work with tend to be quite sensible. It's not going to be a silly buyer draft. It'll be tailored to that transaction. So that's buying and selling companies. And then look, this is the final example of, obviously we do other stuff as well, but shareholders agreements. I bang on about these because they are super important. Any company where you've got more than one shareholder, we would recommend a shareholders agreement in place, even just a relatively simple one. They don't cost a lot of money and they can save a lot of time and a lot of cost in the future. Not to list all the reasons, but 2 very good reasons are what happens to shares on a certain event. It often surprises clients when they've had a falling out of a shareholder and they're like, well, can we just buy their shares back? And the answer is like, without a pre-existing agreement, no, you can't go and take someone's shares off them. So what you can work in is mechanisms in a shareholders agreement and articles as well. But in a shareholders agreement, which basically says if certain events happen, that's a compulsory transfer. If they're a bad leaver, they've had their hand in the till, you might say you don't get any value for your shares or you get half your value. Commercially, you can work it out, but the point there is a certain event happens, you want to compel that person or have at least have the option is actually what you want to be able to get their shares and not have this disgruntled shareholder on your shareholder base. Logic being owner managed business, say you've got 4 shareholders at 25% each, one just disappears, sits on their hands, does nothing, but they're still getting 25% of the dividends, they're still getting 25% of the growth of the company when you come out to sale. Not very fair. Quite easy to see how you've got 3 shareholders there getting quite disgruntled, growing this company for a fourth person who they've had a bit of a bust up with. Having a shareholders agreement in place can definitely help that. And another reason to consider those types of events is on a sale as well. You might have a minority shareholder, might even be an employee that holds 1% of the shares. A buyer comes along and says, I want to buy your company. You think happy days, I'm going to sell. Actually, you can't compel that minority shareholder to sell their shares, and a buyer might want to buy the whole lot. It sounds daft, but it can happen. Certainly, if people have had a bit of a falling out, and people will cut their nose off to spite their face. So having a right that says to that minority shareholder, look, if I want to sell my shares, you sell your shares, what we call a drag right. Very, very important with minority shareholders to include there. That's just a couple of examples. Flip side, not flip side, but a very good reason is having some reserve matters. Basically, this is just a list agreed between the shareholders that says the company can't do X without consent of either me as the majority shareholder or a collection of us of shareholders. This is important because it stops things happening without the consent, and it's also important if you're a shareholder but you're not involved in the business. Happens quite a lot with investors. Or if you're taking a back seat, at least you can sit and be comfortable. Yeah, you're not going to the board meetings, but the company cannot do X, Y, and Z without including you and your consent. Really, really important things to have. Not there in the default position at law. This is why shareholder agreement kind of enhances that position. And I think if you're all still awake, it's just questions. If there are any, if there are any questions on any of that.
I have a question for you.
Yeah,
Um, if someone's considering selling their business, at what point should they engage your services?
yeah. I mean, it's worth having a conversation as soon as they are considering selling their business. So it depends where they are with it. If they've got a potential buyer, often if you're selling a business, it's going to be a trade buyer. You know who's going to buy your company. It's probably your competitor or someone who can integrate your company. If they're at that sort of stage where having a discussion,
Mm,
definitely worth engaging a lawyer and just saying, heads of terms, getting the heads of terms right,
mm,
um, makes the whole transaction easier. So I would say as early as possible. And on that point as well, I don't obviously do this. I'm a lawyer. I'm not an accountant. But having some sort of either corporate finance, depending on the size of the business, or at least an accountant to say, is the value right? It's what the buyer's looking to buy. Are they are they giving you a fair value for your company? Does it reflect that? Look, an owner manager might know that or might be happy, but it's
mm,
always good to get that involved. But yeah, I'd certainly say as early on having that conversation, and if they're involved at negotiations, getting heads of terms with a lawyer. Often
mm,
we get clients come to us and say, I've signed these heads, can we do the deal? You look at the heads of terms and you go, why have
mm,
you agreed? Why have you agreed to all of this? So yeah, as
mm.
soon as we can really. And on that, often we'll just have a chat with them. We won't start the clock running. We'll just have a chat and say you probably want to do X, Y, and Z. When you get to your head stage, give us a shout and we can start the clock running then when we can actually add value.
Brilliant. It's helpful to know that, because I do have conversations with people who are thinking about selling their businesses. So, that's helpful to know.
Yeah, and I sort of pulling together I call it a flyer, but it's just like a one page which sort of says things to consider if you're looking to sell your business. So that's just in typing with our marketing team. So I'm happy to share that. It kind of
Mm,
just gives a
please.
few pointers on that.
Yeah, that'd be
Well,
brilliant. Thank you.
no worries.
Philip, I've dealt with a couple of cases over the years where people have sold their business, but then things have gone wrong. Largely, the purchaser has not paid the consideration, but it can be other more sort of personality related issues. And in my experience, there's usually been some fairly obvious clauses there about rights for the purchaser to take the business back. Um, but I suppose two-part question. One is, are those clauses always in and are they advisable? But I suppose a second question would be, would you advise someone to, to try to take back a business that's sort of part way down the road and hasn't been in their control for a while, or is that really a recipe for disaster?
Um, I mean, the answer is it's a classic lawyer answer, isn't it? It depends. But yeah, to answer, I mean, I think it's in essence very specific circumstances. If you've sold a business, um, and you're not running that business, that's a lot. And you're sat on the beach, hopefully in the Bahamas, having spending your money. If you then got to, do you really want to be able to take back the business? And actually, even if you were not on the beach in the Bahamas, who's been running the business? What's gone wrong? Like maybe now it is a bag of nails, and also what liabilities are in that company now that you're going to take on? You don't, you would have to carry out a full due diligence exercise to and renegotiate a deal, getting the warranties and indemnities from the buyer to take it back. I think just taking it back as a and we so to answer your question, Colin, like, do we is it always there? No, not really in the share purchase agreement. And is it advisable? I think it really depends on where on how the if it's an earn out and you're going to be in the business for 3 years after completion and you're going to have complete visibility of the business, you're basically going to be running it. You might be more comfortable to take it back and know what's in there because you're involved, rather than if you completely remove from it. You sometimes see a provision like that, and this might be where you're referring to it, is an around security, a security over shares in the company that's been sold. Again, it produces the same problems, and it actually, in terms of, do you really want to take this company back? Does that get you where you want to be? And often with that provision, um, it's more to get the value back by the sale of the shares, as opposed to getting the shares back so you can go and run the company. It's nuanced, but I mean, we don't see it a lot because of what I've said. You can just see there's so many potential problems that it could give. But that doesn't mean you couldn't have that as an option on various circumstances. Does that answer your question, Colin?
Yeah. Just interesting to hear what you think, really, because both the instances I dealt with, unfortunately, the person that took the business back um, was, I suppose, led by heart rather than head, and didn't really take on board the fact that they were going to inherit a lot of new debt. And hence why they finished up having to deal with me. So yeah, it's not. I think it's a decision that anybody looking at that kind of decision would have to look at astonishingly carefully.
Yeah, absolutely. And to say it again, just like if someone was at that stage, then it's not my bag, but it's definitely Melissa's bag to deal with that. But yeah, you could deal with the initial drafting, but you'd need to be really careful. Do you really want this as the option? I think the way I would look to guarantee the cash is, by way of security, by way of a guarantee, not just, from a corporate company that's got, a strong balance sheet, being able to call on the whole of the debt. It doesn't guarantee it, or the whole company, the buyer company could go bust, but it just gives you various ways, and clearly try and get as much cash as you can on day one, really, is what I would say.
Yeah. Thank you.
I don't know if Mal, I don't know if you was on mute when.
Well, you partly answered it. I was going to ask about independently valuing the business before you get involved in it. You said about buyer beware, but I presume you could engage the accountant to do a report so that you know you're not buying a pup.
Yeah, so the way we normally see it is from a buy side perspective, the buyer might make an indicative offer on some of the information they've had or received from the seller, but
Mm.
um, but any offer like that will be subject to proper financial due diligence, your accountant or proper engaged FDD, financial due diligence service, will properly have a look and value the company and see whether, like I say,
Yeah.
is it a pup or is it okay. But normally, what happens, Mal, is initial conversations will happen without the lawyers involved. In all honesty,
Right.
between a buyer company. And I'll go, just can you share us over your accounts, your management accounts, give us some general financial information so we can make a bit of an assessment as to whether this is a viable company.
Mm.
But any sort of heads of terms are always going to be subject to contract and are always going to be subject to due diligence. And that's where a buyer really gets into the weeds of the finances and and we do see it where a buyer might go, well, actually, we're going to have to reduce the price here or reduce the payment terms
Mm.
because we don't. It's not as viable or it's not as profitable as we thought it was on our initial assessment, and that does happen.
Yeah, I've come across it a few times where there's a divorce and the company needs to be valued so that someone can be bought out.
Yeah,
It's quite expensive, from what I can remember. I think it was, the wrong side of a couple of thousand to have an independent valuation done. But also, it sounds like there are lots of pitfalls. So, is it months? I mean, a conveyance can take 4 months at the moment. So, how about average buy and sell? Is there no rule? Does it take months to buy and
I,
to
I,
sell?
I would look. I would say on average it's probably 2 to 3 months from engaging lawyers and starting. I've done huge transactions in 3 weeks, and I've done small transactions that have took a year. Not because of me, but it really depends. I think the better answer to that is you've got various processes with acquisition. You've got to The big part of it is due diligence, and that can take a long time. It all
Yeah,
depends how long that happens, and often if it's a trade buyer, they know this type of business inside out. They know what they're looking for once they lift the bonnet.
yeah,
It's a lot quicker. They might have better processes in place and conclude due diligence a lot
yeah,
quicker. And you can negotiate. Your big aspect of that is your share purchase agreement, negotiating that, which you can do side by side. But if everyone's sensible and you can sort of, what we do is we want to get stuff done, not overly quickly at the detriment of the client, but clients always like, we want to get it done quick, want to get it done quick. It's just having that honest conversation with the other side. We're all trying to get a deal done here. I want to buy, this person wants to sell. It's kind of
mhm,
reaching that middle ground. And if
mm,
everyone's sensible, it can be quite quick. To give an example, that 3 week transaction, that was a huge transaction.
yeah,
Um, north of £40 million deal value. You think
oof,
this is going to take forever?
mm,
We was instructed full DD and everything, all in 3 weeks, and completion. And that was a
yeah,
pre-budget one before they changed the entrepreneurs relief before, down to 1 million rather than 10 million. So it was
yeah,
the urgency was there, and everyone was engaged
yeah,
to do that. So it depends on
yeah,
engagement, but a ballpark two to 3 months, depending on size of transaction. If that helps.
yeah. Thank you very much, Phil.
No, thanks.